Sam, welcome back. Let's talk about this new program that I heard you talk about in the office the other day. That is very interestingly, available to a lot of clients that potentially could be investors, those that like to collect portfolios of many different opportunities that we have available in real estate. Obviously, I heard that if you have certain parameters in how many properties you can own with the regular conventional loans, then you are restrictive on what type of loan you could qualify for. So let's talk about this program, what it has to offer, and who is the perfect candidate.
I love it. This is my favorite thing to talk about in real estate. This is the program that I love the most. I probably on our team have done a significant amount of these out of all the guys that are on our team. So I love it. So it's basically called a DSCR loan, right? Debt service coverage ratio, right? It's basically an investment style loan where there's no DTI.
Wow.
Yeah, so there's no debt to income requirement, right? So what that means is they're not getting income documents from you. And by they, I mean underwriting. We're not collecting any of those documents from you. It's just your credit score. Is your credit good for the program? And does the rental income cover the mortgage, the future mortgage that you're going to have on that property? If the rental income covers it, that's the whole program. That's the entire loan program. Those two factors.
So technically the idea is to find a property for a client, to see that the property will cover itself on expenses on the rental.
Yep.
And then as long as the expenses on the mortgage do not exceed the rental expense.
Correct.
Right?
Correct.
Or the rental income.
Correct. So what we look at is the PITI, which stands for principal, interest, taxes, and insurance. So as long as those four things totaled up together don't exceed the rental income on the property, the potential rental income, unless it already has a renter in it. If the future rental income on it does not exceed those things, then the program doesn't work. If it does exceed it, then it works.
Wow, it's amazing, Sam. I learned, it's very fascinating because I feel like being in this industry, your brain can never shut down and rest.
Yep.
I learn new things every single day. And what was really amazing for me to learn by getting prepared for today's podcast with you is that if you own 10 properties with mortgage to one name, then you technically cannot qualify on number 11 purchase
That is correct.
for regular conventional loan. I was very surprised to learn that you cannot have 10 mortgages to your name and then get number 11, and then you're going to get stopped by regular conventional loans. So what other products will be available is something like this. So let's talk about this a little bit more. What happens? How do you justify that? Who is the perfect candidate?
Right. So, yeah, like you said, you cannot, for Fannie and Freddie, the limit, usually the general guideline is that you can't finance more than 10 properties. Now, if you own 20 and 9 of them have conventional mortgages, that last mortgage up to 10, you can still do it. If you can't go for 11, 12, 13, 14, and so on. So it's only 10. So that's where these non-QM programs come into play. So there's a lot of different variations of a non-QM loan. This is just one of them. Non-QM stands for, it's basically just means it's not a conventional loan. That's what it stands for.
Is it supposed to be a short-term loan, like a hard money loan kind of situation, or no?
It's an alternative to hard money. It's not necessarily a short-term loan per se. I mean, there are a lot of people that will do these loans and keep them for rental properties.
Mm-hmm.
The beauty of this loan over the alternative of hard money is that the rates on this are significantly lower. And generally speaking, you could put a little bit less down on something like this as you would have to do on a hard money loan.
Are you restrictive because this is investment property on the down payment requirement?
The minimum down payment that we require is 20%.
20%. Usually it's 25.
Usually,
if it's investment property, you're required to put 25.
Yep. And matter of fact, we'll actually make an exception and go lower than 20% in some cases. So if you have good credit and you have a history of managing rental properties, there are some situations where we can actually go a little lower.
Wow.
So there is the ability to go lower than 20%, which is a no-brainer for a real estate investor because what do real estate investors hate doing? They hate tying up their capital.
Correct. Which I believe different approach. You and I spoke about it.
This, yes,
we talked about it on the personal level. I would rather have 5 properties that are fully paid off. So when I'm retired, I don't have to worry about debt.
I agree.
But some people could have 20 and they all have mortgages and then they just keeping themselves busy floating around. And just, that's not my style, honestly, but that's just my preference.
Yeah, everybody has a different investing style. I agree with you. I think for me, I would rather own one property that nets me $2,500 a month than own 5 and all have mortgages on them, right? And I'm in the mortgage business, so I want to do your mortgage.
Absolutely.
I would love to do it, but I think it's better to have, maybe some people look at that and say, I don't want to have all my eggs in one basket. But for me, I would prefer to be debt free in terms of real estate. We see what's going on with the banks and all these
Absolutely.
things that are happening.
Yes.
So you never know.
So in other words, you will definitely prioritize clients' requests and see what's best for them. You pretty much accessible. You tell them exactly what to do. They communicate with you. And then in the end of the day, you help them pick and select the right program for them.
Correct.
Let's talk about the closing costs on this particular program. Are they more expensive, less expensive? Are they any kind of incentives to this type of programs? And let's dive into that.
Yeah, so typically, closing costs are generally the same on this program as they would be on a conventional mortgage. You still have your title fees, taxes, things of that nature, typical fees that come with the unfortunately come with the purchase of a home. So they're generally the same. Now, I will say in programs like this, you usually have to pay a point or two up front. There is really no way around that which is really the only negative I see. But again, if this is the alternative, paying that point up front, and then having a much lower rate as opposed to doing hard money, hard money too, you have to pay that money back within a pretty short time frame.
Within a year.
Usually within a year. It depends on the terms. But for something like this, you can keep this for 30 years, right? So this is a 30-year mortgage. So let's say, like we talked about it before, if the property...
So it's a fixed rate.
It's a fixed rate.
It's 30 years mortgage.
Yep.
And pretty much if you own multiple properties, you could qualify as long as you have a good, what did you say, management history?
A good history of managing rental properties. So one of the reasons why this program, one of the things you need, I should say, is that you have to have a history of owning rental properties. So we will make what's called an exception if you only have a primary residence and want to dive into this program. But that goes back to needing that 20% down payment then probably. If you have a history of managing rental properties and underwriting looks at that, you'll get away with being a little bit more lenient on a program like this.
Beautiful. And what is the timeline to close such loans?
Actually, they're faster. So most people think that these are a little bit more complicated, but they're actually much quicker because think about it. We're not collecting any income documents from you. We're not collecting any tax returns from you. We're just doing an appraisal on the property. We're running your credit. And then we're just making sure that the rental income can cover the mortgage, and that's the entire loan. So we'll usually wrap these up in, I want to say, probably 20 to 40 days, that timeline, depending on how quick the borrower can get us the documentation. I always say to people, we can close a loan in 7 days if we really wanted to, but it's usually the borrower that takes their time getting us documents and sending things over to us, so it really depends.
Do you need to have a corporation or a company to borrow with this type of loan?
You don't. And actually, the beauty of this program is that you can close into an LLC. You can actually close the property inside of an LLC, which a lot of real estate investors like doing.
Absolutely.
Yep.
Wow, interesting. Well, we're going to pick a topic of LLC at a next time.
Yep.
But thank you very much for covering this. This is a very interesting topic. I find that a lot of people would probably be super interested about this program, and I'm sure they will reach out to you. Thank you very much, Sam, for joining me, and can't wait for our next topic.
Thanks, Olga. Appreciate it.